You're sitting in your favorite coffee shop scrolling through the news on your phone when a headline makes your stomach drop. Dow Jones plummets 478 points in a day. You refresh the page. Maybe it's a glitch. Nope. The S&P 500 is tanking too. Your mind races. What happened? Then you see it. Tariffs. The Trump administration just slammed massive new ones into place. 20% on China, 25% on Mexico, and a jaw-dropping 50% on Canadian steel. Markets are in free fall, Twitter's on fire, and your investment app has never looked this red. You take a sip of coffee, but it tastes different now, like inflation. That grocery bill? It's about to get ugly. Somewhere in Ontario, a premier is probably staring at an electricity tax proposal, rethinking everything. This isn't just some dry policy shift buried in an economics textbook. This is real, it's global. And it's about to hit your wallet, your tech, and even your avocado toast. So what does this mean for you? Let's break it down. A tariff is basically a tax on imports, a fee the government charges when goods come into the country from abroad. In your case, that means every bag of Brazilian coffee beans now costs 30% more than before.
Suddenly, your supplier hikes prices, your expenses go up, and now you have two choices.
Absorb the cost and make less profit. Ouch. Raise your prices and risk annoying customers. Either way, the tariff just made your life harder.
I'm in danger!
You might be thinking, why would the government do this? What do they have against my caramel macchiato? Great question. Governments impose tariffs for a few reasons. If imported goods are too cheap, local businesses struggle to compete. A tariff makes foreign goods more expensive, so people are more likely to buy from local companies instead.
In our case, U.S. coffee bean farmers benefit because their beans are now relatively cheaper than Brazil's.
Every time a foreign company pays a tariff, that money goes into the government's pocket. It's like a toll road, but for goods. Sometimes tariffs are used as a pressure tactic in global trade. If two countries are in a disagreement, cough trade, war cough, one might impose tariffs to force the other into negotiations. So what's the deal with these tariffs?
Oh, really?
Just last week, in early March, Trump had casually tweeted a 25% tariff on Canadian steel and aluminum. Markets tanked. Ontario's premier fired back, threatening to slap an electricity export tax on power flowing south. The standoff lasted a few days, until suddenly Trump reversed course. The tariffs were off the table. Markets breathed again. But now he's back at it, doubling down. Why? The administration says this is all about fixing trade deficits, bringing back U.S. manufacturing jobs, and making sure the country isn't dependent on foreign supply chains, especially for materials critical to national defense. On paper, it's a bold move, one that screams America first. But in reality, it's a gamble, a big one. Because tariffs don't just hit foreign companies. They boomerang right back to the U.S. economy through
higher prices.
That new fridge you were eyeing? It just got more expensive. Your favorite craft beer? Aluminum cans are pricier now. Even your car, if it's not USMCA compliant, could see a steep price hike after April 2nd. Investors are rattled. Wall Street hates uncertainty, and this tariff roller coaster is shaking markets like a 9.0 earthquake. Supply chains are scrambling. Businesses that rely on imported materials, they're redrawing their entire playbook overnight. Some will pass the cost on to you. Others might move production to avoid the tariffs altogether.
How does this affect the stock market?
Wall Street's been on a wild ride. March 11th, 2025 was dubbed the market's worst day of the year. The Dow shed 478 points, 1.1%, the S&P 500 fell nearly 0.8%, and the Nasdaq dipped 0.2%. That's not a one-off. Markets are whipsawing, bouncing between tariff announcements, reversals, and rumors of trade talks. Investors hate this unpredictability. It's like trying to price a stock while blindfolded. Goldman Sachs crunched the numbers. If these tariffs stick, S&P 500 earnings per share could drop 2 to 3%. Every 5 percentage point tariff hike, that's 1 to 2% off earnings. Why? Companies get squeezed. Higher import costs mean they either eat it, goodbye profits. Hike prices, hello, angry customers, or lean on suppliers, who aren't thrilled either. It's a triple threat, and the market's feeling the heat. Now, let's zoom into the economic fallout. Inflation. Tariffs jack up costs and someone's paying. Take Mexico's avocados. No easy substitute thanks to geography and climate. Slap a 25% tariff on those, and your guac's pricier by next week. Same goes for electronics, drugs, and that cheap toaster you snagged online. 20% tariffs on China mean higher bills across the board.
Then there's the big R word, recession.
Peter Ricciuti, a finance professor at Tulane, puts it starkly. In some ways, it's a self-fulfilling prophecy. If you think a recession is coming, then you stop capital expenditures, you don't hire as many people, and then you work yourself into a recession. That's the danger here. Businesses spooked by tariffs could pull back, slowing everything down. The IMF agrees. Prolonged tariff fights could dent global GDP. Retaliation from Canada or China? That's fuel on the fire. Who's hurting most? Sectors tell the tale. Electronics. Companies like Apple have started shifting production to Vietnam and India, but China remains a key supplier. The 20% tariff could result in higher prices for smartphones, laptops, and accessories, or lead to product shortages if companies delay shipments to reassess sourcing strategies. Pharmaceuticals. The U.S. depends heavily on China for key starting materials, active pharmaceutical ingredients, and finished medications. Tariff increases could lead to higher drug costs and potential supply disruptions, with ripple effects throughout healthcare. Packaged goods. Manufacturers of household products and packaged foods are currently stockpiling inventory to delay tariff impacts. But once these reserves deplete, price increases will become inevitable. Automotive. This sector relies heavily on cross-border supply chains, particularly with Mexico and Canada. While temporary exemptions exist for some products, the industry faces significant challenges if full tariff implementation occurs. Companies aren't just sitting there, they're scrambling. Short term, it's stockpiling. Think warehouses stuffed with toothpaste and TVs to dodge the tariff hit. For China-heavy players like electronics and pharma, it's scenario planning. Spreadsheets galore to map out costs and reroute supplies. China +1, diversification. Many companies are further diversifying sourcing beyond China to countries like Vietnam, India, and Mexico. This strategy reduces dependency on any single country and provides greater resilience against country-specific trade policies. More companies are evaluating how to shift production to the United States, reducing exposure to global trade uncertainties. While this improves supply chain resilience, it typically raises labor and production costs. To offset higher costs associated with tariffs and domestic production, companies are increasing investments in artificial intelligence and automation technologies to reduce labor dependencies. These adaptations collectively represent a significant restructuring of global supply chains that will likely persist beyond the current tariff situation, permanently altering patterns of global trade and production. Zoom out globally and it's tense. US-Canada spats, like that steel tariff flip-flop, show how fast things escalate. Mexico, China, the EU, they might hit back with their own tariffs, hammering US farmers or tech exporters. Remember 2018? China's retaliation crushed soybean exports. Round two's brewing.
Beyond immediate responses, the current tariff situation may contribute to lasting structural changes in global trade patterns.
The trend towards shorter, more regionalized supply chains, accelerated during the COVID-19 pandemic, is intensifying as companies seek to reduce exposure to trade disputes and tariff changes. Vietnam, Cambodia, and India have already seen significant growth in manufacturing, especially in textiles, apparel, and electronics. Mexico has also benefited from supply chain diversification, particularly in automotive and industrial manufacturing. The emphasis on national security concerns related to supply chain dependencies could lead to more government interventions in trade relationships globally, potentially fragmenting the international trading system into regional blocs. So, where do we stand? Tariffs are jolting markets. 2 to 3% earnings hits loom. Consumers face higher prices, from produce to prescriptions. Businesses adapt, stockpiling, reshoring, automating to survive. The goal's clear: more U.S. jobs, balanced trade. But the risks? Volatility, inflation, and as Rikiuti warns, a recession we might talk ourselves into. Yet, there's hope. Adaptable companies could thrive. Picture that Michigan worker gaining shifts or a firm mastering automation. Still, the broader costs, market swings, growth threats challenge us all. So tell me, what's your take? Are tariffs a bold fix or a risky gamble? Let's hash it out. This story's far from over.
Also, subscribe to our newsletter on our website at dollarsinthedoor.com to get more updates from us, and follow us on Instagram, Facebook, TikTok, LinkedIn, X, and Blue Sky at Dollars in the Door.